Welcome everyone to our webinar about, this is an informational webinar to explain more details about the process of 1031 exchange of your rental property. So I have here with me Leonard. Leonard is I think you're the founder and the CEO of Asset Exchange Company. Maybe
That's
you
correct.
can, yeah. All right. Well, go ahead, Leonard.
Yeah, thanks for having me, Dee. So it's a pleasure to be here. And I think Heather is going to go ahead and, switch the slides. So my name is Leonard Spoto, and I am one of the principals and co-founders of Asset Exchange Company. We are a 1031 exchange accommodator. So what we wanted to do today was talk to you a little bit about 1031 exchange, make sure you had all the information you needed. If you have questions during the course of the webinar, feel free to type your question into the chat section of the webinar system here. I will see the questions and I'll monitor them and answer all the questions as they are appropriate. So some of you might ask a question that will be more appropriate to discuss at a later point in the presentation. And if so, I will address those questions later. But please don't be shy. If you have a question, we are here to answer all of your questions. If you're working on an exchange and you need some particular advice about your kind of strategy or your situation, share what you're doing. And I think everybody in the group can probably benefit, and we'll talk about what you guys have going on. So again, my name is Leonard Spoto. I run a company called Asset Exchange Company. We are a 1031 exchange accommodator. So as a 1031 exchange accommodator, if you haven't done a 1031 exchange before, just so you guys know, we're not an escrow company. All right. We don't sell title insurance. The only thing that my company does is facilitate 1031 exchanges. Now, the reason why you need a 1031 exchange company is because the government says so, right? So within the kind of the tax rules and regulations that kind of guide you through the 1031 exchange process, basically you have to work with a neutral third party to facilitate the process. So there's a whole cottage industry of 1031 exchange companies that specifically focus on helping clients do just that, conduct 1031 exchanges. So we're going to do three very important things. Number one, we're going to hold all the sale proceeds, because when you do a 1031 exchange, you sell a property, but you cannot touch the funds. If you touch those funds, you're going to be paying taxes. So you need to set up an exchange account prior to the close of escrow. We are going to prepare all the legal documents that are required to properly document your transaction as a 1031 exchange. And then very importantly, we are going to make sure that you are in compliance with all the rules and regulations set forth in the tax code. And the interesting thing about kind of the tax law as it relates to 1031, yes, there is a section of the Internal Revenue Code called 1031, Section 1031, and that forms the bulk of the kind of the rules and regulations. But over the years, there have been private letter rulings and tax court cases that have also given us guidance on how to properly structure a 1031 exchange. So if you think, well, geez, I'll just go into, the tax law and read the tax law about it, there's just so much more than that. And I've spent over 20 years in the industry, and there's something new that we learn every day about 1031 exchange. So it is a very complex, but also just a very niche part of the tax law. As I mentioned, I've been doing this for 20 years, 20 plus years. Started the company back in 2006. Our company is bonded and insured. We do have a tax attorney on staff that's a member of the state bar. We have exchange staff that speak Mandarin, Cantonese, and Spanish. And then when you do work with our company, if you do get audited by the IRS or the Franchise Tax Board, we do provide audit support for our clients. So just a little bit about us. Now, let's talk about 1031 exchange. It sounds like a few of you might have done 1031 exchanges before. I always like to tell people that Section 1031 of the Internal Revenue Code is one of the greatest wealth building tools available to the real estate investor. And the reason why is because it allows you to take money, a large chunk of money that would have gone to the government, and use that to create wealth for yourself. So whenever you sell a property, and we'll get into a little bit more detail on this, but whenever you sell a property and you don't do an exchange, anywhere from 30 to 35% of your profit is going to go to the government. So Section 1031 allows you to keep that money that would have gone to pay those tax bills, and you get to keep that money in your pocket and use it to leverage into bigger and better deals. So Section 1031 is a very powerful tool. In real estate is kind of a special asset class, because if you sell stocks, right? If you own Google stock, or maybe you just made a bunch of money on some AI stocks, well, you sell those stocks, you're paying taxes no matter what you do, right? There are some, I guess, if you have a 401k, you're going to defer taxes, but most of us, when we just buy stocks for our own portfolios, there's no way to defer that tax liability. With real estate, we have that advantage of being able to defer the taxes on that highly appreciated property. So one of the best kind of investments out there, and the way to leverage that investment, is with the 1031 exchange. So I mentioned about 33% or 35% of your gain goes to pay taxes. Now, where do I get that number from? Well, whenever we pay taxes, there's two components of our tax bill. You have the federal taxes, and in most states, you have a state tax. So some of you might be sitting in Texas. You might say, well, I don't have a state tax. Well, fantastic, good for you. But most of us in other states, we do. So our federal taxes are going to be the first big chunk of taxes that we pay. And you've got a 15% or a 20% capital gains tax liability, depending on your income. And a lot of people think that's the only tax they pay. I talk to investors all the time. They say, well, geez, I'll just pay my tax bill. It's only 15%, right? Wrong. Okay, that's just the starting point. That's the low end of the federal tax. As I mentioned, the capital gains tax rate goes to 20% as your income goes up. The federal government also charges you a tax on the amount of depreciation that you've taken on your property. That's a 25% depreciation recapture tax. And then there is a Medicare tax that kicks in for certain income earners at 3.8%. All right, so those are the federal taxes. Now, I'm in California. California taxes start at about 9.3% and go up to 12%, and I think it's actually up to 13% now, and that's depending on your income. So when we talk about taxes, don't get fooled into thinking, well, geez, I'm only paying 15% federal capital gains tax. That is never the case. Now, for those of you sitting in Texas, yeah, you might get out of paying some of these state taxes, but you're still going to have a substantial tax liability from the federal government if and when you cash out of your property. Now, the good thing, of course, is that with real estate, you don't necessarily have to pay those taxes with the 1031 exchange. I'm going to skip this slide because this slide goes into a little bit more accounting details that we don't need to cover today. But the great thing about real estate is it is, one of the most, if not the most tax advantaged investment out there. And the tax advantage that you get depends on the type of real estate that you're selling. So we're talking today about our investment property sales, which are potentially going to benefit from the 1031 exchange, which is a tax deferral. You also have another piece of tax law that many of you are probably familiar with. It's called Section 121, or most of you know it as the homeowner's exemption. So Section 1031 is for your investment property. Section 121 is for your primary residence. And Section 121 of the Internal Revenue Code will allow you to avoid paying taxes. If you're single, you can avoid paying taxes on the first $250,000 of gain. If you're married, you can avoid paying taxes on the first $500,000 of gain. All right. So within the real estate world, there's two kind of really great tax breaks. You've got Section 1031 and you got Section 121. All right. Section 1031 is for your investment property, and that's a tax deferral. You've got Section 121, which is the homeowner's exemption for your primary residence, and that is tax avoidance. Now, I talk about both of these tax laws because there are situations for a lot of my clients where they can use both of these tax laws together on the sale of one property. Let me give you an example. So if you own a 2-unit building, okay, you can live in the top unit and you can rent out the bottom unit. When you sell that property, you can apply the homeowner's exemption to the value of the unit that you live in, and you can do a 1031 exchange on the value of the unit that you rent out. So these tax laws are not mutually exclusive. It's not one or the other. There are certain situations where you can actually benefit from both of these tax laws when you sell your property. All right, so a duplex is just one example. Maybe you have a home with an ADU in the back and you rent out that ADU. Well, the value of your rental unit, your ADU, could be eligible for an exchange, and then the value of your house would be eligible for the homeowner's exemption. So there's all kinds of kind of real world examples of this, and we work with clients who employ these strategies all the time. The important thing is that you just know it's an option, right? Because you might go and sell your property and you might miss out on a 1031 exchange on your rental component of the property just because you or your clients have never heard of it before. So I do want you to know these two tax laws exist, and you can use them exclusively or you can use them together. There's a lot of different ways that these can be used. In fact, you can actually have a home that you live in exclusively, all right, just a primary residence. You can move out of that home and you can rent it out for 2 years, and then you can take a 1031 exchange, but still claim the homeowner's exemption. So that is a phenomenal strategy for a lot of people who have really highly appreciated primary residences. So one of the things that I like to do is just kind of give you ideas on how these strategies can work, so that while you're doing your own deals or working with clients who are doing these deals, things pop in your head and you think, well, geez, maybe I should talk to my 1031 exchange company about the possibility of an exchange here. And then we can let you know whether your client or your plans make sense. And if they make sense, how much tax liability you might be able to save by doing some of these strategies. Okay, so let's talk 1031. So if you're going to do a 1031 exchange, you need to be selling an investment property, all right? We talked about the fact that 1031 exchanges are not for your primary residence, unless, of course, you've got a rental component to that primary residence. But when you do a 1031 exchange, you got to make sure that you're following the rules, all right? And I like to break down the 1031 exchange guidelines into some simple rules at a very high level. So rule number 1, you need to make sure your property is eligible, okay? The way that your property qualifies for 1031 is that it needs to have been used for productive use in trade or business or for investment. Properties involved in a 1031 exchange also have to be like kind. In fact, back in the olden days, we used to call these like kind exchanges. And this sometimes caused confusion for some clients because some people thought, well, geez, if I sell a rental home, do I have to buy another rental home? Or can I go out and buy an apartment building? Well, the good news is that you can actually buy any type of investment or business use property that you want to complete your exchange. All right. So if you sell a rental home, you can buy some land, you can buy some farmland, you can buy an apartment building, you can buy a commercial office complex. You have the luxury of going anywhere in the country. So if you sell in California, you can buy in Texas. If you sell in Texas, you can buy in New York. You have a lot of flexibility on the type of real estate that you buy, and you also have a lot of flexibility on where you buy. Now, there are some limitations, right? You cannot exchange your property from Texas to Mexico or from California to Canada because foreign property is not like kind. So you need to stay in the good old United States of America. The other thing is, if you are a dealer, if you are a developer, if you are a quick flipper, you are not doing 1031 exchanges, because developers and quick flippers, they do not have investment property from a tax perspective. What they have is inventory. Okay. Inventory is something that you create to sell, right? You build a property as a developer to sell it. You're a flipper. You fix and flip the property to sell it. That is inventory. Much like a piece of bread in the bakery is inventory, right? The baker baked the bread to sell it. That's inventory, and that's taxable as such and is not eligible for 1031 exchange. Now, one of the problems with my world is that there's a lot of gray area. Okay, so part of my job each and every day is discussing client situations and whether or not they are eligible for 1031 exchange. And I kid you not, I got off the phone about an hour ago with a client who said, well, geez, mom is selling a property that we have lived in for 7 years. We do not pay mom rent, but instead of paying rent, we pay all of the expenses on the property. We pay the property taxes and we take care of all the maintenance. Can mom do a 1031 exchange on that property? What do you guys think? Well, it's a gray area, right? The easiest way to make sure that your property is eligible for 1031 is rent it out, collect rental income, and report that rental income on your tax filings. Depreciate the property and report the depreciation and account for all of your income and expenses on your taxes. Okay, that is a bulletproof case. If you get audited by the government and you've collected rent for your property for at least 2 years, the government's not going to have a problem. They're not going to challenge the validity of your 1031 exchange. But situations aren't always clear cut, right? The client I spoke to, I said to them, I said, listen, you do not have a clean exchange. You can certainly do an exchange, and if you do not get audited, you won't have a problem. The problem will only come to bear if you get audited. And then you have to prove to the government auditors that your exchange was valid. Now, if it was me, I would probably do that riskier exchange because it's not super risky, right? You had a person in the property other than yourself. The person was paying the property taxes and the expenses of the property. There were some HOA fees, things like that. So it's not a clear-cut disqualified property. What I told the client was, listen, if you don't want to have any risk, if you are very risk averse, do not do an exchange, just sell the property and pay your taxes. All right. Everybody is a little bit different in how much risk they are wanting to take on. Some people say, I want no risk. Well, don't do an exchange then, pay your taxes. If you're okay with a little bit of risk in your exchange and you have some gray area, well, go for it because you can argue your point in tax court if need be. Now, hopefully it doesn't come to that. Hopefully you never get audited, but if you do and the IRS challenges that exchange, you could wind up in tax court. And if you have a really good tax attorney, you might win. All right. So there is a lot of gray area in the tax law. All right. And we know that, and we advise our clients on that gray area. And ultimately, it's up to the client to decide how much risk they want to take on. Now, there are some situations where I won't even work on an exchange because I just know, hey, this is not going to pass. If you even try it, it's not going to. You're not going to have a chance. So those type of situations, I just won't work on. Maybe they'll find another company that will. But what we do is we give you guys guidance on what we think the IRS would rule on, and you guys can make a decision on how you want to go forward. All right. So rule number one is just make sure your property is qualified. Rule number two, when you do a 1031 exchange, if you don't want to pay taxes, you need to remember two things. Number one, reinvest all of your cash. Number two, purchase property equal or greater in value. Now, a lot of people think when you do an exchange, all you have to do is reinvest your profit. That's not the case. All right. So you might have $1 million property that you sold with $200,000 of profit. If you go out and buy a $200,000 replacement property to complete your exchange, you're not buying enough real estate. All right. When you sell for $1 million, you need to buy for $1 million or more. All of the cash that came out of the sale of that property is going to come into the 1031 exchange account and then be used as a down payment to purchase the replacement property. If you had debt on the property that you sold, you're going to need to go out and either get another loan or add additional cash so that you're buying enough real estate. So that's very, very important. And this is one of the biggest problems, is that people, they don't spend the time to read the information that we provide them. They go out and do an exchange and they're just not buying enough real estate. And we catch it, and we call them, we say, hey, you're not buying enough real estate. You need to replace the value of what you sold. They say, oh, no. My brother's uncle's best friend did an exchange and he just reinvested his profit. No, he didn't. Because if that's all he did not have a valid exchange. When you do an exchange, you need to reinvest all of the cash and you need to replace the value of what you sold after commission and closing costs. Now, you can be creative in how you do that. You can sell one property for $1 million and you can buy one property for $1 million. You can sell one property for $1 million. You can buy 3 properties that add up to $1 million or more. You can sell five properties and buy one. All right. So you can do multi-property exchanges. It's just that if you want to defer 100% of the tax liability, you need to make sure you're buying enough property. Now, what happens if you don't? What happens if you sold for $1 million and you buy something for $950? Does that negate the entire value of the 1031? No. Okay. You can, in fact, do what's called a partial exchange, where you defer some taxes and you pay some taxes. Whenever you trade down in value, so if you sold for $1 million and you bought for $950, you went down in value by $50,000. Well, that $50,000 difference is going to be taxable. Now, not the end of the world, but your clients need to know that they are going to have a tax bill due when April 15th comes around, all right? Because they didn't successfully purchase all of the property that they needed to. Does that make sense? Any questions on that? So I know that Dee Dee had mentioned you can post questions over into the chat dialog box. If you have any questions, feel free to type your question in and I'll answer and address those as appropriate. Okay, so Stephen has a good question. How long exactly does a homeowner need to rent out their primary for in order for it to qualify for 1031 exchange? Good question, Stephen. So rule number 1 was that your property has to be eligible for exchange, right? Well, how long do I have to rent that property for it to be eligible? If you want it to be bulletproof, if you don't want to have any problems with the franchise tax board, I want you to rent the property out for 2 years, okay, 24 months. If you rent out your property for 24 months and then you exchange it, the franchise tax board is not going to challenge it. Anything less than 12 months could be challenged. Now, the good thing for you is that if you do rent your property out for, let's say, 13 months, the good thing is that within the tax code, there has been nothing stated in writing on how long you have to rent the property out. They just say, hey, it needs to be used for business or investment purposes. However, here in California, we know that the auditors like to see 24 months. So if you're a California resident, Stephen, I want you, if you want to be safe, to rent it out for 24 months. Now, you also don't have to be safe, okay? You can say, you know what? I only rented the property out for 13 months. I know the risk. I'm going to do an exchange, and I'm going to cross my fingers and hope that I do not get audited. If you do get audited, first thing you should do is call me. And then what we are going to do is help you make a compelling case to the auditors that you follow the rules. Now, how do we do that? Well, we cite different tax court cases, and we also cite the tax code itself, which does not state how long a property has to be owned for as an investment. So, you know, that, Stephen, is a gray area, how long it has to be held. But increasingly in California, what we've found is that the auditors at the franchise tax board are starting to challenge anything less than 24 months. Now, the good thing is that your risk of getting audited is relatively small. Only about 7% of my clients actually get audited. But yeah, if you're in that 7%, it kind of stinks, right? Going through an audit is not fun. So I know it's kind of a non-answer, but it's what we have. Okay, So rule number 1 was to make sure that your investments were eligible in order to do the exchange. Rule number 2 is that if you don't want to pay taxes, you need to reinvest all of the cash and purchase property equal or greater in value. Rule number 3 when you do an exchange is that you have to get it done on time. Now, the government gives you 180 days to complete the exchange. That time frame starts the day you close escrow on the sale. One of the biggest or most often asked questions is, can I get more time in my exchange? The answer is generally no. Okay, the only time that you get more time in a 1031 exchange is in a federal disaster declaration. And unfortunately, we have those all the time now. So we're going to have one for the Texas floods. We had some in Los Angeles for the fires. We always have them in Florida for hurricanes. So when there is a giant weather event or some kind of tragedy and there's a federal disaster a presidential disaster declaration, the IRS will grant extensions to those affected by the disaster. Now, it's not always guaranteed that you will be affected, right? I have clients who own property in Los Angeles, but they are not going to be eligible for the Los Angeles extensions because they don't personally reside in Los Angeles. So it's very important to read how the extensions are worded as well. So we help our clients with that, but keep this in mind. You have 180 days to complete your exchange. Don't count on an extension. Okay, count on getting your exchange done within the 6-month time frame. If you want more time, here's what I advise you to do. Delay the close of escrow, right? Because as I mentioned, the escrow closing date triggers your 1031 exchange time frame. So if you get an offer for the property you're selling, and it's an all cash offer and they want to close in 7 days, that might not be a great offer for you, because then your 1031 exchange is going to start in 7 days. Maybe you counter and you say, well, yeah, we'll take your all cash, but we need 30 days because we're doing a 1031 exchange. So we'll close in 30 days. That gives you a little bit more time before your exchange time frame starts, a little bit more time to look around, a little bit more time to get your ducks in a row. Now, Nira has a really good question. Does the 1031 exchange need to be in the same calendar year? No, absolutely not. Right? So you can start an exchange in December and you will have 180 days to still complete it. Now, you might need to file an extension on your tax return because your taxes need to be delayed until you complete your exchange. You don't want to ever file your taxes until your exchange is done. But does the exchange need to be done in the same calendar tax year? No. I'm sorry, yes, it needs to be done in the tax year. Or let me put that differently. Your exchanges need to be completed before you file your taxes, Nira. So, okay. So 180 days, plenty of time to complete your exchange. What usually will throw people for a loop is the very compressed and tight time period in which they need to identify the replacement property for their exchange. All right, so the government gives you 180 days to do the exchange, but you have to identify in writing what you're thinking about buying to complete your exchange on day 45. So you have 6 months to go out and buy something, but the government says you only have a month and a half, 45 days, to actually figure out what you want to buy. And on day 45, you're going to need to submit in writing an identification letter stating the properties you're considering purchasing. The way that you fill out that letter is very important. There are two primary options for completing the letter. The first way to fill out your identification letter is to use the 3 property rule. Using the 3 property rule, you can submit 1, 2, or 3 properties. Now, once you submit that ID letter on day 45, you are committed to buying property number 1, property number 2, or property number 3, or all of them, or 2 of them. Okay. What you cannot do is buy something different. Once you've identified on day 45, you are now committed to buying properties that are on that list. In fact, we cannot release funds from your exchange account for the purchase of anything that's not on that list. So you're going to submit that ID letter to me, and then we are obligated by law to only release funds for something that is on that list. So if property number 1 gets sold to someone else, you can't replace it after day 45. If property number 2 burns to the ground on day 50, you can't replace it. You've got one property left there on your ID letter, and that is the only property that we can release funds for. So the biggest challenge in a 1031 exchange is finding suitable replacement property within that compacted 45-day time period. Now, again, you can't get extensions unless you're going to rely on a presidential disaster declaration, which I wouldn't do. So what you need to do when you are in a 1031 exchange is you need to look for suitable replacement property as soon as possible. Now, when do you start? Well, you can start whenever the heck you want, right? You do not need to wait until the day you close escrow to start looking for property. You can start looking for suitable replacement property while you're still marketing your property for sale. You can make an offer on a property today, contingent upon you selling yours. So many of my investors who do 1031 exchanges with me will close escrow on the purchase of their replacement property within the first 45 days. So you don't have to wait until day 45. You can actually be very active and aggressive making offers to buy something at any point. You just want to make sure that your property closes escrow, then the next day we can send money out for you to close on your purchase. All right. Now, the 3-property rule, when you identify, gives you 3 properties. But remember I mentioned in the beginning that you can do multi-property exchanges. You could sell 1 property, you could buy 2, you could sell 5 properties, you could buy 1. You could actually sell 1 property and buy 15. But you can't do that with the 3-property rule. So the government gives us one other method for identifying. It's called the 200% rule. The 200% rule allows you to identify in writing as many properties as you want. There's no limit on the number of properties. Okay. However, there's a limit on the value of real estate that you identify. And the value limit is 200% of what you sold. If you sell a property for $1 million, how much real estate can you identify? $2 million, right? So if you sell a property for $1 million and you want to go to Texas and you want to buy a bunch of small properties for $150,000, $200,000, $250,000, you can do that. You can buy 10 properties. All right. You have that flexibility, but when you fill out this identification letter here, you're going to need to check the box that you're using the 200% rule, and then you're going to need to attach a letter with all 10 or 15 of those properties that you're identifying. Now, most of my clients will use the 3-property rule because most of my clients want to sell 1, buy 1, maybe sell 1, maybe buy 2. But on occasion, we do have investors who go to places like Texas or Ohio where you can get really cheap properties, and they'll pick up 8, 10, 15 properties. All right, so that's an option. So let's recap. When you do a 1031 exchange, you want to make sure that your properties are eligible. You need to reinvest all of the cash and purchase property equal or greater in value. You have 180 days to get your exchange done, and you need to identify what you're thinking about buying on day 45. Those are the really high-level rules for doing an exchange. So if you can remember those when you're out talking to clients or when you're thinking about doing your own transaction, you're going to be in a very good position. Now, it's not required because if you're like me, you're probably going to get off this call and you're going to forget most of what we talked about. That's fine. What I would recommend that you do is pull out your cell phone, put in my phone number into your cell phone, and then when you have an exchange that comes up, or when you have a question from a client about a 1031 exchange, you will have the resource available to you to get that question answered if you can't remember what we talked about here. All right. So you'll see my phone number here at the bottom of the screen. It's 877-471-1031. Pretty easy to remember, but put it in your phone and you will have access to my team, myself, and our 20 plus years of experience in the 1031 exchange industry. We don't charge for any consultations. We just talk to people as part of business development activities. So happy to chat with you guys anytime. So we have a question. It says, if I use the 200% rule and I sell for 1 million, can I buy up to 3 million? No. You can't, right? So if you're using the 200% rule, the maximum value of real estate that you can identify is $2 million worth of real estate. If you're looking to buy $3 million worth of real estate, you need to identify using the 3 property rule. So if you sold for $1 million, you can identify property number 1 for 1.5 million, property number 2 for 2.5 million, and property number 3 here for $3 million. That works. Okay. So be very careful on how you identify, because if you don't do it correctly, the IRS is going to disqualify that 1031 exchange. All right. So I'm going to look over here and see if we have any other questions that I wasn't able to answer. While I'm doing that, if you guys do have other questions, go ahead and type them into the dialog box. I do have a few more slides that I can discuss here. Okay. So what happens if the IRS disqualifies my exchange? Well, in the worst case scenario, you could go to jail for tax fraud. I'm not joking. There was a real estate agent who did a 1031 exchange. You can Google her name. Her name is Cheryl Savage. So go ahead and Google that, Cheryl Savage 1031. Cheryl Savage did a 1031 exchange and she falsified her tax returns to make a property that she was selling look like a rental when it wasn't. She got audited. She got caught and she served, I think it was 14 months in jail for tax fraud. So what happens if the IRS disqualifies your exchange? Well, hopefully you don't go to jail, but you could for tax fraud. All right. In most cases, that's not what's going to happen. In most cases, when you do a 1031 exchange and it gets disqualified, you have to pay your taxes. You have to pay interest and fines. All right. So if your tax bill was $250,000, you're going to pay that. You're going to have some interest on that, and you're going to have some fines as well. So you don't want your exchange to get disqualified. And usually it's not as simple as an exchange gets disqualified, because usually what happens is you end up in tax court and you're paying a tax attorney $500 an hour to defend you. And then you end up losing. And then you end up paying your tax attorney. You end up paying your tax liability. You end up paying the penalties and the fines. So what we don't want to have happen is have your exchange disqualified. Does it happen? Absolutely. Right? Because people like to push the boundaries. I told you earlier that if you are a flipper, you're not supposed to do 1031 exchanges. I know flippers who do exchanges all the time. And they just sit back and they cross their fingers and they hope they don't get caught. Okay? If they get caught, they're going to pay taxes. All right. So everyone has their own kind of risk assessment that they do. People think, well, geez, I'm not going to get caught, or I'm a unique situation, and this is why my property qualifies. Well, you need to assess the risk for yourself and and kind of figure out for yourself how risk averse or how aggressive you want to be. All right. I'm going to always tell you what's safe, and then you're going to sit down, hopefully with your CPA, and decide, well, does that make sense? And what do we want to do? Nira is asking another question about switching to the primary married filing. Okay. So we talked earlier about kind of the two tax laws that are involved with the sale of real estate. You have your section 1031. Let's just go back there. You have your section 1031 for investment property. You have your homeowner's exemption for primary residence. Okay, most of the time you either live in a home or you have a rental home. And it's very clear cut. If you live in a home and it's not rented out, no component of it's rented out, you get your homeowner's exemption as long as you've lived in the property for 2 out of the past 5 years. If you have a rental property that you have never lived in, the only tax break that you will get is the 1031 exchange. All right. You don't get to kind of pick and choose what tax law you get. How you use the property is going to determine what tax law or tax break you get. So, as I mentioned earlier, there are situations where you might have a duplex. That's one property. You live in the top and you rent out the bottom. The top unit that you live in will be eligible for the homeowner's exemption. The bottom unit that you rent out is eligible for the 1031. So hopefully that answers your question, Nira. If not, maybe you could be a little bit more specific on your issue. Okay, so Stephen's got a really good question. Stephen wants to know about trading down in value. So what's going to happen is when you trade down in value, the difference is taxable. So if you sell a property for $1 million and you buy something for 50, the entire $50,000 is taxed at about 33%. The government assumes that all of the dollars not reinvested are going to be your gain or your profit dollars. There is no prorated amount. You might say, well, geez, that's not fair. I completed 95% of my exchange, so I should only pay 5% of my taxes. It's not how it works. All right. The government makes the rules. We just tell you how they work. When you trade down in value, that amount is taxable. All right. So I'll give you a really bad example, Stephen. Okay, let's say you have $1 million property. You have $200,000 of profit in it. Okay. In order to defer any taxes, you need to buy $1 million worth of real estate, but you don't. You end up buying $800,000 worth of property. You sold for $1 million. You had $200,000 of profit. You bought for $800,000. Guess what? All of your gain is taxable because you traded down in value by $200,000. You had $200,000 of gain. So in that situation, there is absolutely no benefit to doing a 1031 exchange. You just didn't buy enough real estate. All right. And don't be confused. There's no pro rata or proration going on here. A lot of people think, well, geez, I completed 80% of my exchange, so I should get credit for that. Nope. It's not how it works. Okay, so we're getting a couple other questions on what type of kind of properties qualify. So let's go back to our rule number 1. A lot of people ask me, well, geez, I want to be creative and have some options on what type of real estate I buy. Can I buy a REIT? Are you guys familiar with what REITs are? REITs are real estate investment trust. They are generally publicly traded, so you can buy them on the stock market. A REIT is a company that owns a bunch of real estate. And the great thing about those investments is you own real estate through the REIT and it's completely passive. You get your portfolio exposure to the real estate market and you get some maybe income and dividends from it. REITs, unfortunately, are not real estate. Okay. A REIT is a company that owns real estate. So REITs are not eligible for 1031 exchange. You have to sell real estate. You have to buy real estate. However, because of the popularity of REITs and the popularity of 1031s, the REIT industry said, well, geez, we need a product that functions like a REIT that is eligible for 1031. So a bunch of smart guys and smart girls got her into a room with a bunch of smart tax attorneys, and they said, well, geez, how do we structure a property that is a passive institutional investment that clients who like REITs can exchange into? So they came up with a product called a DST, a Delaware Statutory Trust. The trust will own a property, like $100 million apartment building in Texas. And that trust will sell you a beneficial interest, a little slice of the property. Now, the trust is going to manage the property and deal with the tenants and all the expenses and everything. You are a passive investor in that property. And a lot of people like those because they're completely passive, right? If you're an 85-year-old person who's been managing tenants for 50 years, you're sick and tired of it. You don't want to sell the property because your tax bill is going to be too much, but you're sick and tired of managing it. What do? Well, this is an option. It's not a REIT, but it functions like a REIT. It is a passive institutional investment through what's called a Delaware Statutory Trust. So outside of traditional real estate, this is really the only other thing that you can exchange into. All right. So you got land, you got apartment buildings, you've got offices, you've got rental homes, you've got duplexes, triplexes, all the traditional real estate is exchangeable in and out of. And also this new product, relatively new, called a DST, a Delaware Statutory Trust. Now, those are sold through DST brokers. My company is not a DST broker. We don't sell those. We're a neutral third party to the exchange process. We don't sell you anything. All we do is facilitate your exchange. But if you need a DST broker referral, we can give you one. All right. So that's about it, guys. There's some other real quick things I can talk about. We've got a few minutes left, so I'm going to breeze through a couple things. One of them is something I don't want you to ever have to do, and that's called a reverse exchange. People ask all the time, well, can I buy my property first in an exchange? Yeah, you can, but it requires a reverse exchange, which number one is very expensive. Number two is very difficult to get financed. Number three, it's going to cost you more in terms of transfer taxes and escrow fees. All right. So can I do a reverse exchange? Can I, instead of selling and then buying, can I do the opposite? Can I buy first and then sell? Yes, you can. I want you to know that yes, a reverse exchange is possible, but we don't like them because they're really messy. They're really tough to finance and they're a lot more expensive. So we do them because sometimes clients get in a situation where they have to do a reverse exchange, but the clients generally don't like doing them because they spend about $15,000 to $25,000 extra in fees and expenses to have to do a reverse exchange. So are they available? Absolutely. Are they fun to do? Absolutely not. Will they cost you more? Absolutely. But know that they are out there as an option. All right. Okay. I'm going to go ahead and wrap up. There's a bunch of other slides on here. We talked about almost all of these issues here. But I want to give you guys my contact information. My phone number is on there. You've got my email address if you want to shoot me a quick note. If you didn't feel comfortable asking a question with the group here, shoot me a personal email and we'll be able to answer and address your concerns. I want to thank Dee as well for having me, Dee. So thank you very much for putting this together and having me on as a host.
Thank you so much for this wonderful presentation, Leonard. It's very, very useful. We learn a lot.
Well, thanks for having me, Dee. Appreciate it.
Yeah. Okay. Well, before you guys go, we have posted a poll here that you can choose. So if you can help me by filling up those polls, that'll be great. If you have any questions, please let me know. You guys know where to reach me. All right. Thank you so much, everyone. and have a wonderful day.